The Choppiness Index, or CHOP-P, is a technical indicator designed to determine market conditions. CHOP measures the efficiency of price movement by comparing the distance price has traveled to its overall volatility. CHOP distinguishes between trending markets with directional price movement and choppy or consolidating markets where price moves sideways. The Choppiness Index oscillates between 0 and 100. Lower values indicate a trending market, while higher values suggest a choppy or sideways market. Here are the key characteristics of the Choppiness Index. First, CHOP identifies the market's character, whether it's trending or moving sideways. Importantly, CHOP does not predict price direction. It won't tell you if the market will go up or down. Higher values, typically above 60, indicate sideways or choppy markets, while lower values, generally below 40, suggest a trending market. Traders use CHOP to select appropriate trading strategies based on current market conditions. In summary, the Choppiness Index helps traders identify whether to use trend-following strategies in trending markets or range-bound strategies during choppy sideways conditions. The Choppiness Index, or CHOP, is calculated using a mathematical formula that compares market volatility to the overall price range. Let's break down the components of this formula. N represents the look-back period, which is typically set to 14 days in most trading platforms. ATR of 1 refers to the average true range calculated for a single period, which measures volatility. Max high of N is simply the highest price observed during the N period look-back window. And min low of N is the lowest price during the same N period window. Let's break down the calculation process step by step. The CHOP formula can be understood as a ratio of volatility to the total price range, normalized using logarithms to produce values between 0 and 100. Logarithms are used to normalize the result, giving us a consistent scale regardless of the specific security or time frame being analyzed. From a mathematical perspective, higher CHOP values indicate more choppy trendless markets. Conversely, lower values suggest the presence of a stronger directional trend. The Choppiness Index readings are interpreted on a scale from 0 to 100. Let's examine how to interpret different CHOP values on this scale. Values below 38.2 suggest a strong trending market. This indicates clear directional movement and strong momentum in one direction, making it ideal for trend-following strategies. The middle zone between 38.2 and 61.8 represents a transition phase where the market is neither strongly trending nor clearly consolidating. Trading strategies may need to be adjusted in this zone. Values above 61.8 typically indicate a choppy, sideways market with no clear trend. This is when the market is consolidating, and range-bound trading strategies tend to perform better. These threshold values, 38.2 and 61.8, are derived from Fibonacci ratios, which are significant in technical analysis. It's worth noting that these thresholds can be adjusted based on the specific market being analyzed. Some traders adjust these thresholds based on the volatility characteristics of the specific instrument they're trading. More volatile markets may require different threshold settings. Let's compare the Choppiness Index with other popular technical indicators. Unlike directional indicators such as MACD or RSI, the Choppiness Index doesn't predict price direction. CHOP specifically focuses on measuring market consolidation or sideways movement. MACD identifies momentum and trend direction, making it useful for trend-following strategies. RSI helps traders spot overbought and oversold conditions, often signaling potential reversal points. ADX measures trend strength but doesn't indicate direction, making it somewhat similar to CHOP. The Choppiness Index complements other indicators by determining which type of trading strategy is most appropriate for current market conditions. When CHOP is low, the market is trending, making trend-following strategies more effective. When CHOP is high, the market is consolidating, favoring range-bound trading approaches. Let's examine the key differences between CHOP and the average directional index. ADX measures trend strength regardless of direction. CHOP specifically identifies consolidation periods. ADX rises in strong trend. CHOP decreases during strong directional moves. ADX helps confirm trend strength. CHOP helps determine appropriate strategy type. The true value of the choppiness index comes from using it alongside other technical indicators. CHOP doesn't replace other indicators. Use CHOP to select appropriate trading approach. Combine with directional indicators for complete analysis. CHOP answers when to use other indicators. The choppiness index is particularly valuable for selecting appropriate trading strategies based on market conditions. When the choppiness index is low, below 38.2, the market is exhibiting strong trending behavior. In trending markets, strategies that follow the direction of the trend tend to perform well. These include moving average systems, breakout trades, and momentum-based approaches. Conversely, when the choppiness index is high, above 61.8, the market is ranging or moving sideways without a clear direction. In choppy, range-bound markets, mean reversion strategies are more effective. These include buying at support levels and selling at resistance, using oscillator indicators to identify overbought and oversold conditions. The key to improving your trading performance is adapting your strategy based on the choppiness index readings. When CHOP is below 38.2, the market is trending strongly, making trend-following systems like moving averages and breakout strategies more likely to succeed. When CHOP is above 61.8, the market is choppy or range-bound, making counter-trend strategies like mean reversion and support resistance trading more effective. By selecting strategies that align with current market conditions, as measured by the choppiness index, traders can significantly improve their performance and avoid using inappropriate approaches for the current market regime. The choppiness index can be applied to any time frame, from intraday charts to weekly or monthly analysis. Notice how shorter time frames naturally show more choppiness. The 1-minute chart displays high CHOP values, while weekly charts tend to show lower values. Because shorter time frames naturally show more choppiness, threshold adjustments are necessary for proper interpretation. Each time frame requires different threshold settings. Intraday charts may use higher thresholds of 60 to 65, while weekly charts might use lower thresholds of 38 to 45. Many traders use multiple time frame analysis with CHOP, looking for alignment between longer and shorter time frames. This approach offers several benefits. It confirms trends across time horizons, reduces false signals, improves entry and exit timing, and creates a more balanced trading approach. Alignment between timeframes provides strong confirmation of market conditions. When all timeframes show trending conditions with low CHOP values, the signal is much stronger. However, when different timeframes give conflicting signals, such as a trending daily chart but choppy shorter timeframes, traders should exercise caution. The choppiness index produces several recognizable patterns that provide valuable trading insights. The first important pattern occurs when the CHOP indicator falls and breaks below the 38.2 level. This pattern confirms that a new trend is forming in the market. As CHOP drops below 38.2, it signals increasing directional movement, and traders should prepare for trending conditions. The second pattern appears when CHOP rises and crosses above the 61.8 threshold. This indicates that a previously trending market is now entering a consolidation phase. As CHOP moves above 61.8, the market loses directional bias and becomes more choppy and range-bound. Traders should adjust their strategies accordingly, often moving from trend following to range trading approaches. The third significant pattern is the compression expansion cycle, which represents the natural rhythm of markets. In this pattern, CHOP rises as the market consolidates, shown by the compression phase where price moves sideways. Then, CHOP sharply falls as a new trend emerges, represented by the expansion phase where price makes a directional move. This cycle tends to repeat as markets naturally flow between trending and consolidation phases. Let's summarize the key CHOP patterns to watch for in your trading. First, when CHOP falls below 38.2, prepare for a new trend. Second, when CHOP rises above 61.8, expect consolidation. And third, Recognize the compression expansion cycle as a natural market rhythm. The most successful traders adjust their strategies based on the current chop pattern, using trend following approaches during expansion phases and range trading strategies during compression phases. Despite its usefulness, the Choppiness Index has important limitations that traders should be aware of. The Choppiness Index is a lagging indicator, which means it confirms market conditions after they've already begun. For example, a trend may begin at this point, but the chop indicator only confirms the trend after some delay, potentially missing early trading opportunities. The standard 14-period setting presents another limitation. It may be too slow for very active markets or too sensitive for longer-term analysis. CHOP can also give false signals during volatile market conditions, with rapid price changes but no sustained direction. These false signals can lead traders to misinterpret market conditions, confusing short-term volatility with meaningful trend changes. Finally, like all technical indicators, the Choppiness Index should not be used in isolation. It's most effective when combined with other technical indicators and analysis methods as part of a comprehensive trading system. To summarize, the Choppiness Index has 4 key limitations. It's a lagging indicator. Its standard period setting may need adjustment based on market conditions. It can give false signals in volatile markets, and it should always be used as part of a comprehensive trading system. Most traders use a 14-period setting for the Choppiness Index, but this can be adjusted based on your trading style. Day traders typically prefer shorter periods of 8 to 10 to capture quick market movements. The standard 14-period setting works well for swing traders looking at medium-term trends. Position traders often extend to 20 or even 30 periods to filter out short-term noise and focus on longer-term market shifts. Many trading platforms allow customization of threshold levels beyond the standard 38.2 and 61.8 Fibonacci values. The standard thresholds classify markets into 3 states: choppy markets below 38.2, trending markets above 61.8, and neutral conditions in between. Some traders adjust these thresholds based on market characteristics and trading style. For instance, using more aggressive thresholds like 30 and 70 to better filter market conditions. Some traders apply smoothing techniques to reduce noise in the Choppiness Index. Here we see the raw chop indicator, which can be quite noisy and generate false signals. Applying a 5-period simple moving average smooths out some of the minor fluctuations while preserving most of the original signal's responsiveness. A 10-period simple moving average provides even more smoothing, eliminating most noise, but at the cost of some signal delay. The most effective approach is to test different settings on historical data before applying them in live trading. First, select historical data specific to your market. Different assets can display varying degrees of choppiness. Test various period settings to find what works best for your trading timeframe. Experiment with different threshold levels to optimize signal quality. If needed, apply various smoothing methods to reduce noise while preserving important signals. Finally, evaluate the results against your specific trading strategy to ensure compatibility. Remember that there's no one-size-fits-all setting for the Choppiness Index. Always optimize for your specific market, time frame, and trading strategy.